This podcast includes information provided by the issuer and does not express the views of the interviewer. This podcast may also include forward-looking statements by the issuer that involve certain risks and uncertainties to its business. Because forward-looking statements are subject to risks and uncertainties, the issuer's actual results could differ from those indicated in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. You can follow Planet MicroCap on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT, and you're listening to episode 86. If you have any questions or comments, please feel free to tweet at me or shoot me an email at rkraft@snnwire.com. And when you do get a chance, if you like what you hear, please rate and review Planet MicroCap on iTunes. It really helps provide feedback for me and spread the MicroCap message. For this episode of the Planet MicroCap podcast, I spoke with Gary Mishuris, Managing Partner and Chief Investment Officer at Silver Ring Value Partners. Gary and I met on LinkedIn, and after doing some research on Silver Ring and his publication, behavioralvalueinvestor.com, I wanted to learn more about his investing insights, process, and strategy. The goal for the interview is to learn more about Gary's research process, as well as a discussion of behavioral biases that occur to investors and how to overcome them. Thank you again for tuning in to episode 86, and please enjoy my interview with Gary Mishuris from Silver Ring Value Partners. But first, a word from our sponsor. To my loyal listeners, subscribers, and fans, Robert Kraft here, your host on the Planet MicroCap podcast. The 2019 Investor Conference season is upon us. Where are you going this year? I'd like to take a second to invite you to join me and maybe a few of the guests you've heard on this podcast to our annual MicroCap Investor Conference, the Planet MicroCap Showcase, April 30th to May 2nd, 2019 at Bally's Hotel and Casino in Las Vegas. The Planet MicroCap Showcase will be 2.5 days of company presentations, networking opportunities, an educational workshop, and you will get to meet privately in one-on-one meetings with the management of well-known emerging growth private and publicly traded microcap companies. We are back with new surprises and programming that you will not want to miss. So join us for the Planet MicroCap Showcase, April 30 to May 2nd, 2019 at Bally's Hotel and Casino in Las Vegas. For more information and register to attend, please visit www.planetmicrocapshowcase.com. See you in Vegas. For this episode of the Planet MicroCap podcast, I would like to welcome Gary Mishuris, Managing Partner and Chief Investment Officer at Silver Ring Value Partners. Gary, welcome to the Planet MicroCap podcast.
Well, thank you very much for having me. I really appreciate it.
It's great to have you on, and I really appreciate you taking the time to come on here. And thank you for the LinkedIn request and for us able to connect that way.
Absolutely. I'm really glad we connected.
Same here. All right, so let's get started here. You know, what is your background, and then how'd you get your start investing and in the world of finance?
Sure. So, I was studying computer science and economics at MIT during the tech bubble, which was about 20 years ago. And, I was lucky in a way that probably is going to sound counterintuitive, which is I thought I was smart. I was studying these subjects, so I bought a tech stock, and, all the tech stocks were supposed to just go up. It was supposed to be a one-way market, no sure way to make money for a poor college kid working two jobs. And luckily for me, I picked the one tech stock in 1999 that was not going up. It actually went down, which is shocking. Talk about skill in the wrong kind of way. And just around that time, Warren Buffett happened to come and speak on campus at Sloan, which is the business school at MIT. And I didn't know much about him. I just knew he was this rich billionaire investor. But I figured, hey, I'll go and I'll listen to him talk. So I went, and it just kind of took right away. You had this guy talking about long-term, intrinsic value, competitive advantage, thinking about predictable economics, which made me realize that everything that I thought I was doing that was, in my mind, investing really wasn't, and it was really speculating. So I think that was very fortunate for me, because had I bought a stock like a tech stock based on my non-existent process at the time, and it had done well, I think I would have gotten the wrong lessons from that, and might have never become a value investor. But be it as it may, I think that encounter with Buffett really made me want to learn more and more about value investing. And I was fortunate. I started reading a lot about it, and then I was able to get a job straight out of undergrad at Fidelity in equity research, where I had a terrific mentor. It's a gentleman by the name of Joel Tillinghast, who manages a low-price stock fund, who's just a terrific investor. He actually recently wrote a book that I highly recommend as well. And I think working for my first 3 years under him really helped me become a better investor.
Mm-hmm. So one thing I have to ask is, most people who I interview on this podcast, their first experience with Warren Buffett is reading his letters, his annual letters, or reading something that he's written or about him. But you had the good fortune that you just so happen to be at MIT, and he came to speak. I mean, what was that like? That must have been incredible.
Well, it was standing room only audience, so that was my first sign that he was a pretty popular guy. But you also have to remember, this was the tech bubble, right? Mm-hmm. And a lot of times, people were saying around that time, he lost his touch, he doesn't get it anymore, he doesn't understand tech, that it's a new paradigm, it's EV per eyeball or something like that, as opposed to the old traditional valuation metrics. So his quote unquote stock was flying quite low at that time. So even despite that, I think there was quite a bit of demand, and it was just, he has a manner about him that he makes the complex simple, mm-hmm. which I think is a hallmark of a great investor. And he just really gave me this aha moment that I might have still gotten had I been reading what he wrote, but I felt like it was much more powerful in person.
Mm-hmm. That's really cool. So then from your experience of Fidelity to where you're at now, what can you fill that gap there? What happened from when you left there and then when did you start at Silver Ring Value Partners?
Sure. So I was fortunate that, again, I spent the first 3 years of my career with Joel, because it's one thing to have this theory of, you have intrinsic value and you have margin of safety and all these concepts, and they're good concepts, right? But this is not a theoretical endeavor. You actually have to go out and apply them. And there is nothing like having a mentor who's a master investor who can actually give you feedback. And I remember and Joel is not a very talkative person. So anyone who's met him would probably know he's a bit quirky in a good way, but very, he's an introvert. He's not out there mm-hmm. giving lectures to people who work with him. Mm-hmm. However, I remember one time, I got a note. I had a cube at the time, not far from his office, and I got a note from Joel, and it was my stock recommendation. So, Fidelity, as an analyst, you ranked stocks. So you rated them 1 for a strong buy, 2 for a buy, 3 for a hold, 4 for a sell, 5 strong sell. And he wrote down all my stock tickers that I was covering at the time. I was covering a small cap industry or two. And he put my ratings in one column, and he put the return on equity in the next column. And immediately it was obvious to me that I had this inverse relationship, that I was recommending these cheap stocks that were quite low in ROE. And if you think of ROE, you can maybe think of it as a first cut for business quality. And then I was avoiding all these high ROE companies that were good, much better businesses, but they were expensive. And I remember running into Joel's office and saying, "But Joel, we're value investors. It's not about just the quality of the business. It's about the price to value relationship." And he kind of shrugged his shoulders and went back to reading his 10K. So or whatever he was reading. So I think that was very formative to me, because I think it kind of, when I started, I was in very much of a Ben Graham mode of tangible value. You can measure it, low PE or low price to book. It was less low price to book. It was more low PE, low price to free cash flow. If it's not cheap, I don't want it. And I think that experience, as well as a number of other experiences over time, started to make me appreciate quality to a far greater extent. So anyway, spent 3 years at Fidelity. I left after 3 years for the simple reason I didn't get promoted. So, very, very straightforward. And back then at Fidelity, you needed to have 15, so 1-5 portfolio managers who are going to say, yes, this person, should get promoted to the next level.
Wow.
And most portfolio managers at Fidelity, unlike Joel and maybe 2 or 3 others, were really not value investors. They were, focused on the next 12 months, relative earnings, who's going to beat the quarter. They were paid annual bonuses, and there was a limited market within Fidelity at the time for a long-term value investing approach. And I had a number of supporters. Will Danov was one who managed the Contra Fund. Joel was another, but not quite 15. And of course, at the time, I was devastated, right? And it was funny because on the Thursday before the decision, they used to give out every 6 months awards to analysts. And I got a Creative Research Award for a piece I did on the industry. And I'm like, wow, they appreciate my work. Maybe I'll get promoted. And then I come in on Monday, and the director of research, and the head of investments has a serious expression. I'm like, that doesn't seem good. They're not smiling. It wasn't one of those things where you were fired. I had plenty of time. So, a number of people, including Joel and Will, references. So I did not have trouble finding a job, but it was certainly kind of at the point in time, it felt, it sucked. That's the technical term. However, in hindsight, I think what forced me, well, one is it allowed me to continue on the value investing path, whereas had I stayed at Fidelity and had to serve 50 portfolio managers where 45 or more of them are not value investors, I think it would have made me a worse investor, or at least a more conventional, shorter term investor. And two is I think it made me kind of angry, and the way I handled that anger is I tried to get better. I started reading even more, started trying to become an even better investor. And trust me, at that time there was plenty of room for improvement. So it's not that I've mastered things after 3 years. I won't go year by year to spare you the gory details, but I ended up with a place called Evergreen Investments. It was owned by Wachovia, which was a bank, which was not that wasn't necessarily a good thing, but there was a gentleman there who was given the mandate to build an intrinsic value team. And I had a few different options. I had 3 offers at the time. And what appealed to me about the situation is that it was going to be a cohesive team where intrinsic value was already accepted as the established standard. So you don't have to go in and try to convince a portfolio manager that, we shouldn't look at technical charts. We should be looking at the price to value relationship. That was already going to be the norm. And now you're going to be discussing, like, how do you actually do it? Where do you look for ideas? What is the value of this business or something like that? Regardless, did well there, got promoted to senior analyst and then junior co-portfolio manager on the large cap value strategy, which was a very interesting experience because up until that time, I always thought of terms like overweight and underweight as pertaining more to my waistline than to how to, in my case, unfortunately, more over than under, than to how to position a portfolio. But I quickly learned that, the big marketing-driven firm, the business of investing, very frequently has a big pool, and sometimes the pool in a very different direction than kind of the profession of investing might suggest. Anyway, Wachovia, the parent company, essentially went out of business in the financial crisis that followed. Wells Fargo took us over, and we lost a number of people in the team. The team got split in half, and then our old chief investment officer ended up as the chief investment officer at Manulife Asset Management, and he lifted out our half of the team. And after having kind of endured 3 years as the co-portfolio manager in the large cap value strategy, I didn't really want to manage another conventional strategy. It was just too painful to have these arguments of, well, should we own any energy stocks with oil at 200 and we can't find any values? Well, the benchmark has this weight, so therefore, it's just not a fun way to spend your time. So when we were talking about the lift out, he asked, he actually sent me this really detailed spreadsheet with my various paths my compensation could take at the different scenario. I said, listen, Chris, that's all great. I trust you. Otherwise I wouldn't be coming. Let's talk instead about launching a concentrated strategy where basically I'm going to manage money the same way that I manage my family money. Now, at that point, I've been managing my family money for 7 or 8 years, and I never thought there should be a big gap, right? Like why would you manage someone's money vastly differently than how you would manage, your own family's money, assuming it's for similar objectives, meaning you're not managing a municipal bond fund or something like that. That might be a different. But if you managing money for the long term. There shouldn't be a big difference, if any, regardless. So he agreed, and so I joined Manulife. I was both a senior analyst, and I was able to launch this focused value strategy, as we called it. I would say 85% of what I wanted.
Mm-hmm.
It was a bit of a sales job with the head of marketing, and I remember I wanted it to be 10 to 20 investments as an example, and he, in this meeting said, "Well, that's too few." I said, "Well, how do you think about that being too few? Like, I always like to think about things from first principles, right?" And he had, of course, no idea why that was too few. He just didn't know of any other strategies. There were 10 to 20 stocks, so to him it seemed unconventional, and therefore it was too few. So we kind of bargained a little bit, like in the Turkish bazaar. I said, how about we had 5 here? He said, well, how about we had 20? And we met at 20 to 30. So, I wanted 10 to 20. He wanted 30 plus. 20 to 30 was a decent compromise. I could still do 20, and that would have been fine. So I would say I got 85% of what I wanted. And then, fast forward a few years, 3 years later, the strategy hit 3-year numbers, which, by the way, I think the industry does itself and our clients terrible disservice, marketing funds based on these 3-year numbers, which statistically don't mean very much. I'm not that good at math, but even I know that. And yet,
Don't sell yourself short, okay? MIT grad. I'm sure you're very good at numbers.
well, the thing is, I've actually met the people who are good, so I know where I stand in the pecking order of mathematical ability.
Fair enough.
So, but at the 3-year mark, the salespeople said the numbers are great. We got to go and build a business and gather assets. And so I was kind of at a crossroads. My wife is a doctor, and we had twins. So we have 3 kids now. Our twins were 2 at the time, and we told them that Mama helps people, which is how we explained what she did. And my son, Ben, started walking her out the door saying, "Have a good day at work, Mama, helping people." And then, a couple of weeks later, he started doing the same thing with me. He started saying, "Have a good day at work, Papa, helping people." So it made me kind of like really question, like, what am I doing? Right? Let's say I go and we gather a whole bunch of assets. The firm makes a lot of money. Great. I'll make a good amount of money. Fine. But at that point, I was financially comfortable where, we could drive whatever car we wanted, but we had a Toyota, and that was not going to change. We liked the Toyota. It was fine. We had a decent house that was, moderate house that fit our needs. We weren't looking for anything, change in lifestyle. So I was thinking to myself, like, why am I going to do things that might not be exactly what I want if I have the ability to go and try to do something where I could go back to my son Ben and say, here's what I'm doing to help people. So that was really the genesis of how I decided to start Silvering Value Partners. I went to my chief investment officer and said, look, it was one of those, it's not you, it's me, and it really was. They've been great. He's been gracious. The comp was great. It was nothing about that. It was more, I've done this for 15 years at that point. I really felt that I was both ready and I really wanted to do something different where I could really start with a blank sheet of paper and, do things without, not compromise 80-20, but try to do 100% the way I think it should be done. So left on very good terms. He actually invested in the partnership, as did a few of my coworkers. And that was 2016, and here we are.
Nice. So what is before I get into the investment philosophy, what would you say then is the mission of Silver Ring Value Partners?
I would say, my goal is to use what I do to have people and institutions achieve their financial objectives better than they could otherwise. So again, my wife's a doctor. There's no way I can help people in a way that's as directly impactful as that. But look, I grew up poor. We were immigrants to this country. I grew up without a father most of my life, and I saw my mom, put her first dollars of savings into mutual funds. And she was smart, but it was very hard to pick one because there was all this marketing and this and that, and most mutual funds didn't do that well. And so for someone like my mom who started saving late because she only came to this country when she was 40, so she didn't have that first 15, 20 years of savings and compounding, the performance of that mutual fund was really going to impact when she would be able to retire. So to me, it wasn't some theoretical thing where you go and you find these clients and make as much money off of them as possible. It's, you should make money if you add value, but only if you add value. and also try to do it in a way that's a real partnership and hopefully help them advance their goals and make their lives better. So combination of capitalism, but capitalism where both parties win as opposed to this kind of whatever the market bears goes kind of thing.
Gotcha. So then now to the investment philosophy. On your website you have 5 points to it. What are they, and why are you focusing on these factors?
Sure. So I think the intrinsic value is probably pretty non-controversial, and maybe a quick kind of story. I mean, I mentioned Warren Buffett, and kind of the first time I met him. So when I was at Fidelity, I was very fortunate to be able to go to Berkshire Hathaway meetings, and back in the day, Alice Schroeder, who was the Morgan Stanley analyst who wrote one of the books on Buffett, Snowball, she would do this dinner for clients where 100, 200 clients could come and meet Buffett, have a dinner with Buffett, and he would answer questions. So I asked him, my first year out there, about 18 years ago, I said, well, how do you look at a company for investment? Like, what do you do? And it really kind of stuck in my mind, because what he said was, well, first I look out 5-10 years and I ask myself this question of, can I approximately estimate the key economic characteristics of this business? And if the answer is no, then I pass. And if the answer is yes, then I proceed to try to approximately estimate an intrinsic value range, and then I want a big margin of safety. So anyway, that was a segue into the first component is intrinsic value. It's the idea there is that you buy partial ownership pieces of a business. You're not just trading pieces of paper who derive their value from what the next person is willing to pay for them in the market tomorrow or the next day. The second kind of tenet is margin of safety. Intrinsic value, first of all, it's uncertain. So that's why it's a range. Second of all, it changes. Businesses can evolve. Developments can happen that can make a business more or less valuable. And so the idea of a margin of safety is you want to have a price to value gap sufficiently large that if you're wrong, you still do okay. And to me, my understanding of margin of safety really evolved to be a combination of that price to value gap and the quality of the underlying business. And the reason for that is I've made such big mistakes in estimating intrinsic value that when I look back, A, I'm embarrassed, but B, it made me realize that for some of the lower quality businesses, it's easy to fool yourself into thinking you can easily value them and be overly precise in your quantification of that value. They're so unpredictable that a lot of times the value is going to end up being so different from what you thought that almost no amount of margin of safety from the price can overcome that. Mm-hmm. The third tenet is a long-term time horizon, and I think look, I worked at large investment firms for 15 years prior to striking out on my own. And I mean, the business pressure is real. Incentive pressure is real. I mean, think about it this way. Like if you come to a portfolio manager who works for, one of these shops and you say, here's a proposition for you. How about you're going to get a great 3-year annualized rate of return on investment? Let's say 20%, something really attractive. But the first 2 years have to be terrible. Like that's the condition on which you get this great 3-year return. A lot of them would say no, we can't, because some of them say, well, why don't I just wait for end of year 2 and buy it then? Well, that's a separate conversation. But the reason they can't is they'll not make their bonus. They will get fired. Their clients will fire them because they haven't educated their clients, or they haven't selected the kind of clients that can look through that first 2 years. So there's a real time horizon arbitrage in the market, but it only is there if you actually have the staying power yourself, and that, which means that your clients need to have a very long duration of capital to actually weather that that period of time when the performance might or might not be there. So I think the long-term time horizon is very important, because at the end of the day, I'm not trying to help people achieve a 6-month outcome or a 12-month outcome or even a 3-year outcome. My hope is to help people achieve 10, 5, 10, and beyond year outcomes. Mm-hmm. I mean, the fourth point is, look, I'm an MIT guy by training. I was an engineer, and I think in terms of systems and the repeatable processes. So, I mean, there are investors out there that have a lot of flair and they can just kind of pick stocks out of thin air and they have a good gut feel. I don't. I don't have a gut feel. I try to create replicable processes. So to me, being rational and disciplined is really important because what I'm trying to do is create a system of repeatable steps that I can then use to make decisions over and over again. And of course, over time, the goal is to refine those and make them better. But at any given time, whatever my best state-of-the-art process is, I'm going to stick to that 100% of the time.
Mm-hmm.
And then finally, a concentrated portfolio, I think there's a limit to that. I've met some people who, they have 40% or 50% of their portfolio in one stock. They've read the Buffett partnership letters and they say, well, Buffett had 50% American Express during the salad oil scandal days, so I'm going to do that too. That's not me. I think there's a lot of hubris in that, and I've just been wrong so many times in my career that I'm not going to put half of my capital. No. But by the way, a lot of times the people who do it, they're kind of talented analysts who after 3 to 5 years started their own firm or got a fund to manage, and they haven't been humbled yet. I've had the benefit of investing through 2 downturns, the 01, 02, 03, and the financial crisis, and I know how even the best conceived investment theses might play out differently than you can imagine. So for me, a concentrated portfolio is 10 to 20 investments, and the idea is that I can be wrong on any one decision, not just any one investment thesis, but any one decision which might span across several investment theses, and still have the rest of the portfolio be able to overcome any potential loss within a year. So in practice, means I really structure it in a way that I can't lose, or I shouldn't be able to lose more than 10% on any one decision, because if you lose 10%, 90 can go to 100 within a year, assuming you're on average right on the rest of the portfolio. Mm-hmm. But if I lose 20%, for 80 to go to 100, that's a 25% rate of return in a year, and I'm just not that good.
Gotcha. So I wanted to follow up on the first 2 points real quick, and on your point of intrinsic value, and then also on margin of safety. So first part, for intrinsic value, and again, this is a MicroCap podcast. We're looking at companies 500 million in market cap or less. Mm-hmm. Some don't have historical revenues. Some may have just had their first revenues maybe in the last year, or even just turned a profit for the first time. So for those types of companies, how do you calculate intrinsic value? And then also conversely, maybe a little bit more about how you would calculate that margin of safety for these quote unquote riskier businesses, only because they don't have that those same historical financials.
So I think, I guess the way I would approach it and the way I do approach it, because I do invest in microcap. So the beauty of being on your own is that I don't have to focus on any superficial metrics, and I can focus on what matters, which is the business and the price and the people and the balance sheets and so forth. So my market cap range is well under 100 million to well over 100 billion in terms of what's currently in the portfolio. So I don't discriminate on market cap.
Isn't that nice?
It is, and that was, by the way, one of the bones of contention is that to be managing a meaningful fund that was meaningful for a large company, it needed to be 3 to 5 billion or bigger, and at that point you can't logically spend time on a 200-300 million market cap, even if it was an amazing idea. But anyway, back to your question. Mm-hmm. So first of all, I don't think the process structurally changes based on market cap. And what I mean by that is, I'll explain my process in a second, but I don't think you kind of say, well, these are microcaps, so we cut corners. The process should be the same. However, I think where you put a little bit more emphasis, I think can change, and I'll tell you what I mean. So I have what I call the 5-step research process, and very briefly, step 1 is company quality assessment. Step 2 is figuring out the key economic variables and reasonable ranges of values for them. Step 3 is financial modeling. Step 4 is valuation. And then step 5 is a behavioral checklist. So within step 1, the company quality assessment, which is probably the most difficult, where there's the most art. Because investing is both art and science, and the art isn't how you crank out a DCF. The art is in the inputs and a lot of other things. So within company quality, there is the business, there's the management team, and then there is the balance sheet. So I would say what I do focus a bit differently on in terms of microcaps is, I think the people matter even more than with large businesses, because I think you always want to, with management teams, you want two things. You want competence, and then you want alignment. So I would say alignment matters even more because I think, with a small, company, a microcap, you might have basically one or two key guys, and then the rest of the folks are just kind of executing the orders, right? You don't necessarily have the same depth, sophistication, but you can much easier find an owner operator who has the same skin in the game and might own 10% of the company or 20% of the company with you. So I think in the microcap portion of the spectrum, if you find that, that's a very good sign to look for. While as in large caps, it's rare, right? Certainly there are some situations where people have very meaningful ownership, but it's much more frequent that you have kind of the typical hired hand. The consultant does the compensation, package, the smorgasbord of metrics, blah blah blah. I guess one place I would push back on the premise of the question is I do think having some reasonable financial history is important, because I guess what I like to say is I'm not in the public market venture capital business, which is if a company is small because it's immature and it has no history of profitability, for me that's a pass. Unless it's like a net or there's some asset-based value that where the value is from the assets and not from the going concern value of the business, I think for me it's too hard. But I do think because there's so many companies, the microcaps, you can afford to pass on the vast majority of them and just look for the ones that have the good history and that have at least decent management and have a safe balance sheet where they can withstand adversity, and then wait for a price to value gap. Which, by the way, why would we look at microcaps, right? Part of the reason is obviously they're more likely to get mispriced, right? You don't have 20 analysts following them. You don't have, giant investors. Warren Buffett isn't competing with you in the microcap space, right? So I think because the mispricings are more frequent and they can be much bigger, I think you should, in poker terminology, play tight and wait for things to line up rather than to say, well, I'm not going to demand the same characteristics that I would demand in a different business.
Right. So, that's microcaps in a nutshell, is that it's a lot of investors trying to take advantage of the inefficiencies in the market, and it sounds like you're on that same mindset.
That's right.
So then, another question I had then is, once you found a potential new investment, what are yours and the firm's investment process? What do you do from there?
Yeah, so I think that I really do put it through that 5-step research process. And for me, it starts with reading. So I'm a big believer in understanding both, not just the financial history in terms of the numbers, but what was the context. So I download all the possible annual letters and I read them, and I'm looking for a few things. First of all, I'm looking for the narrative for what happened with the business's profitability over time. But also, I'm kind of trying to judge the management through the way they communicate. I wrote an article a few months ago on some of the best CEO letters out there, and they really stand out. When you see a good letter, it's a partner writing to a partner, explaining what happened, the good and the bad, how does that fit with the plan and the strategy, and how the CEO, your partner, the operating partner in this case, is handling these developments to try to create as much value for all the shareholders as possible. When you read a typical letter, what you see is a lot of self-promotion, a lot of kind of cookie-cutter letters that are, spitting out numbers that almost obfuscate what's happening as opposed to illuminate, and they certainly withhold the negative way too much and focus on the positive way too much. So I think by studying the letters first, you get a sense of both the management team and how they think about you, or do they think about you kind of as this annoying shareholder they have to write to and find the IR department will help them come up with a form letter and they'll customize here and there, or do they really treat this as a partnership? And also you get the context for the history, because financial analysis is not just taking a history, let's say 10 or 20 years or 5 or whatever, and saying, well, it did X dollars in earnings, therefore it's going to do it again. It's a starting point for thinking, okay, this is the company had this cash flow stream historically. Here's why. Now let's think about what is or isn't changing going forward. What are some structural drivers that might be different over the next 10 years? And so that's kind of how you start to form your opinions. And then I mentioned the quality assessment. I really spent a lot of time there, which, by the way, this already presupposes that it passed my initial kind of screen that I want to do work at all. Most companies I look at, they're not particularly interesting to me as businesses, so I pass. Or the valuation is, not particularly attractive, so maybe I put it on the back burner. But let's say it's a promising enough business and there's potential for it to be mispriced. So I think, to me, I want to assess, the industry structurally, and I like to think of it as an analogy. So think about a ship on a body of water, and you have a crew. So you have how turbulent is the body of water. Mm-hmm. So is it really calm, like a nice quiet lake, or is it kind of like a very turbulent sea? Then you have how good is the ship, and then you have how good is the crew, right? So the body of water is the industry, right? And some industries just have structural dynamics that almost nobody can earn an excess return over a cycle, no matter how good they are. Other industries, almost everyone does well, right? It's important to know which one you're at, and I think the 4 or 5 forces framework is very appropriate as a starting point, probably with some modifications to actually go and make that assessment. Mm-hmm. Then I think really important is, what is the company's sustainable competitive advantage? And the reason it's important is not because it helps generate high returns, but because I think it determines how predictable the business is. So if you have a business that doesn't have a sustainable competitive advantage, it's really at the mercy of external factors. And to give you an example, one of the first companies I covered, I thought that mid-cycle free cash flow and earnings per share, it was a small cap company, when I was an analyst at Fidelity, I thought it was $2.50, give or take, over at the mid-cycle point, and I bought the stock at around $20, thinking, well, it's kind of an average business. I multiply 15 times 250, I get around 40. I'm buying it for close to half. That's my margin of safety. Mm-hmm. And then 10 years later, I look back. I was no longer following this company. And by the way, I thought if I were wrong, maybe instead of 250, it would be 2 or 150. Well, it was 25 cents. That's humbling, right? And the key thing I missed was there was really no sustainable competitive advantage. They were in a weak portion of the value chain where they were stuck between large, suppliers and large, powerful customers. And when the dislocation came, the economics flowed to other parts of the value chain. So I think thinking about that, while it's hard to reduce to a formula, I think it's very important. So I think that's important. I think the balance sheet is probably the easiest to analyze, but I think a lot of people are too focused on the income statement nowadays. And I think it's important to look at all 3 statements, but particularly asking yourself, can this balance sheet withstand adversity? Meaning, if an economic downturn comes, or a company just loses some market share, or product cycle fails, are they going to be a forced seller of equity? Are they going to dilute the intrinsic value per share and be a distressed issuer? Or do they have the wherewithal to survive that period of distress without diluting you? So I think that's pretty important. So it's company quality in terms of business and sustainable competitive advantage. It's management quality in terms of competence and alignment, and it's the balance sheet in terms of ability to withstand adversity. Though that's really how I start. And then the modeling and the analyzing key economic variables and valuations, happy to walk through that if you want. But I would say that almost flows out of that first step. If you get the first step wrong, nothing will save you. You can do the best DCFs in the world, but if you get the business wrong, or the people are crooks, it's just not going to help you.
Right. Well, I would, but the main reason I brought you on, and that I thought was pretty interesting, is actually your other firm's publication that you have, the Behavioral Value Investor. So for those who may not know what that is, and we'll get more into it in a minute, but what is this publication about?
Sure. So I'm a big believer that investing is difficult not because just of the analytical difficulties, but because of the behavioral biases that we all have. And Buffett is famous for saying that you need sufficient intelligence, but you really need to have the right temperament. And I think that's right. But also, in addition to temperament, we all have biases. Well, except for me. No, I'm just kidding. We all have biases, right? And one of them is overconfidence, right? That's where you guys listening on the podcast probably saying, well, of course we all have biases, but not me. Or my biases are pretty small. I'm okay.
Right.
Maybe, but chances are that's a bias in and of itself. So
Right.
how do you fight these biases? You can't eliminate them, by the way. There's been studies, and Danny Kahneman's talked about this in numerous interviews, that just knowing that you are biased doesn't make you less biased. So I'm a big believer in combining ideas from behavioral finance, creating checklists, and thinking through and rigorous processes to minimize these biases. So what might be an example might be, being at least aware of the base rate probabilities of success of a certain endeavor. So let's say you're buying a high PE stock. That doesn't mean that it can't be undervalued. It could totally be undervalued, but just starting from the point of view that on average, high PE stocks do worse in the market should at least give you some, pause to at least be a little bit more rigorous. Or let's say, knowing that you might be victim to confirmation bias, where you already own something, you have a thesis, and now you're ignoring disconfirming evidence, should at least cause you to seek out this confirming evidence. For instance, I had a company that blew up last year. There was a short thesis out there. I actually made a point of trying, through a mutual acquaintance, connect with a short seller, and we had a very helpful call. I gave him my perspective, but that wasn't why I was calling him. It was really, I wanted the strongest possible negative thesis on my holding to help debias me, because what if they were right and I'm wrong? I don't want to assume that I'm right just because I would like to be right. So behavioral value investor, the idea there is to marry the discipline of value investing and these things we talked about, such as margin of safety, intrinsic value, long-term time horizon, with the premise that even with those tools, we're going to be fallible, we're going to make mistakes. The way we can make fewer mistakes is be aware of behavioral biases and then systematically try to create behavioral defenses and build those into our processes.
So it's almost like value investing meets human fallibility.
That's right. And it's not just, so I teach a value investing seminar to business school students here in Boston. And when I teach them, I always tell them the main thing you want to do is you want to customize. When you're at a certain level, when you're at a high enough level, you want to customize an investment approach to your own strengths and weaknesses. And so the same thing is with behavioral biases. You have to observe where are you systematically more prone to mistakes, and then create checklists or processes or kind of circuit breakers to minimize the chances. For instance, I've systematically sold too early most of the time, but not always. And so recently I've been thinking, like, why am I doing this? Well, and it turns out that there are two types of selling mistakes I made. So basically, you have a situation where, let's say, this thesis is working out, and now the price to value gap is closing. And I have a certain cutoff where I start to sell the stock. It's systematic, blah, blah, blah. But here's the problem. I've systematically sold things too early when the fundamentals were going well, but it was purely based on the valuation. So that's not an invitation to not be disciplined. But so I started thinking, what's happening? And I think what's happening is I'm too anchored to my initial value, so I'm not processing new information dynamically enough, and I'm just so relieved that something I bought for 60 is now the 100 that I sell, and I look back 3 years later, I could have legitimately, not just ex post ante because of the outcome, but legitimately based on information available at the time, held for 130 or 140. That's a huge difference, right? Because you're not gonna have, not everything is gonna be a winner, right? So if you consistently cut your winners short inappropriately, that's a big leak in terms of process. So and that's, to me, there was an aha moment. This is anchoring. And so now I've built in a process where I use something called the thesis tracker, where for every quarter I put in a color, bright green to bright red, of how well is the thesis tracking as objectively as possible, meaning does the information in the quarter support or reject or is neutral vis-a-vis my long-term base case thesis. And what I do with that then is, let's say the price to value gap closed, but there were 2 or 3 green quarters in a row, then rather than blindly sell, I re-underwrite the business. And the idea there, by inserting that step, is that well, I know I'm prone to anchoring. I know that, this company has been doing better than my base case based on my own thesis tracker. Rather than blindly sell because now price to value is close to 100, let's look at it again in light of this new information to make sure that that $100 of value shouldn't be 110, 120, 130 or something like that. So that's an example. But it also can be useful for non-professionals. Part of my goal, to be honest, is I think there's so much bad advice out there. People trying to sell you Bitcoin or whatever, or some scam product where they're going to make a lot of money off of you. That my goal was to write articles that would be helpful to the general public. I never talk about specific investments because I don't think it's appropriate or helpful to give kind of stock ideas to the masses because I think they can do more harm than good. But to talk about concepts where people, even if they're using index funds or something like that, can still make better decisions.
So my next question then, when it comes to behavioral biases, because I think, we're not going to be able to cover all of the different biases, but I think it would be good maybe for the lay investor to know, what are some of these, you mentioned a few, like confirmation bias and whatnot, but maybe what are some of these behavioral biases that come up in the investing world? And then maybe in your expert opinion, what are some of the questions you should be asking yourself if you happen to have one of these biases as an investor?
Right. So I think, I actually wrote an article to this effect, but I think that I'll give you a brief overview and I'll talk about kind of one of my kind of generic checklists that I use as a starting point. So overconfidence is certainly one. So I think that it pairs very well with base rate neglect because how does it work? Well, let's say another example. We know that the majority of all large acquisitions fail to add value, right? So that's the base rate. The base rate is if one of your companies just announced a large deal, odds are based on just the base rate that it's value destructive. But we're overconfident, so we analyze it and say, well, that's the base rate, but Gary, figured out that it's okay this time, right? So that's something that it's pretty common that's happening. We talked about anchoring. Another one I would mention is recency bias, and I think that it's very prevalent in the sense that we as investors give too much weight to recent events as far as over extrapolating them into the future. So if a company, let's use a pharma company example. When a pharma company announces that a key drug trial failed, the typical Wall Street reaction is to assume the whole pipeline is terrible. And when a company announces a pretty big success, the rest of these guys are really smart, genius R&D people, and the rest of the pipeline is very valuable. So there's this overreaction. So again, that's part of the reason the long-term time horizon helps, so you can zoom out and process information in its proper context. Other things that you should keep an eye out for is things like social proof. For instance, as value investors, a lot of time we see, well, Seth Klarman bought this company, must be good. But even that's a bias, right? That's a social proof, and you have to be careful. Now Seth Klarman buying an investment probably means he has a positive base rate, so there's maybe some information there, but to go and blindly copy that, I think, is a mistake. Another, example is, commitment, bias, right? So part of the reason I try to minimize talking about specific investments is, let's say I go out and I tell you stock XYZ is amazing, this is why I own it, it's better than sliced bread, here you go. And let's say next quarter or the following quarter, negative information comes. Do you think I'm going to be equally likely to be honest with myself about the future prospects of this business, taking into account the new information? Probably not as objective as I would be if I had not publicly just announced to the world how amazing this company is, right? So things like that. I think there's many of them. There are certainly resources, and I have links on my site to some of them where you can go ahead and come up with the common biases. The goal isn't to categorize 100 biases, and there really are that many.
Right, of
course.
The
goal is to systematically defend. So I have this, what I call the skeptics checklist. And so here are some questions that I use in real life to actually go through. So first one is, do I understand this business well enough to approximately estimate its key economic characteristics in 5 to 10 years? We talked about that. Next one is, how strong is the company's competitive advantage? And even, by the way, recent insight, maybe even more important, or at least as important, is it getting stronger or weaker? A big source of my mistakes has been companies that used to have good competitive advantage, but where it's either getting weaker or it's gone, but I'm looking backwards and I'm thinking it's still there. Another good question is, what would it take for this company to be out of business in 10 years? Because again, this actually fights a lot of the biases, because we kind of start falling in love with an investment, we do some work, maybe we meet the management, now we feel even better. They told us all this good stuff that's going to happen to the company. And so we're very biased towards thinking about positive developments. So force yourself to think about negative. What would it take for the business to be gone? And the corollary to that is, what would it take for the business to have their profits below the current level in 5 years? About 15 years ago at the Berkshire Hathaway meeting, Buffett said, the reason that the average sell-side earnings growth estimate is so high at 12%, while we know the reality is going to be somewhere close to GDP, is because nobody ever models 5-year earning decline. Now, like if you look at almost no company, unless they're already like maybe Sears or something like on the verge of bankruptcy, barring that, for large companies, people don't forecast that they're going to earn less than they're currently earning. Another good one is, how much time and capital will it take for someone, such as a new competitor or a new entrant, to turn this into an economically unattractive business? And there are a bunch of others. I don't want to bore you. The article has a bunch of others, but I think you want to be systematic. You want to kind of go through this checklist, and then you should customize this to your own tendencies. Like, I have a friend who doesn't sell early. He's really good at that, but he changes his mind too much. Like, that's what according to him. I mean, that's my judgment. He says, Gary, you have this problem with selling too early. I sell early. I sell just fine. Thank you very much. But I, frequently change my mind. That's a strength when reacting to new developments, but I can also get shaken out of my thesis a bit too much. So now you might want to build a checklist. No, for that, right? So I think it's not about using one generic checklist. It's about starting with good, questions and good defenses against biases, and then understanding yourself, understanding how you make decisions, and then coming up with a checklist that's most effective for you.
No, it's really interesting what you're talking about, in the sense that, it's all about developing your process. It's one thing to recognize that this is how you tend to even invest, or this is how you look at these businesses, but what's more important is, well, what are you going to do about it? You're just going to keep making the same mistakes, or are you going to put something in place so that you can check yourself,
That's right.
So, I want to move on to one of my favorite questions to ask, because I think look, we could go on for hours. I feel like talking about different behavioral biases and even the psychology of an investor. But I would love to direct my audience to go and read some of these articles that are on both the Behavioral Value Investor, right? Not on Silver Ring.
Correct.
Viper.
Yeah. So it's behavioralvalueinvestor.com. You can check them out. They're under Insights. They're probably 20 or so different ones. So
Gotcha.
Check them out.
Cool. So my next question then is, what would you say is an investing experience that has guided your current investing thesis the most?
Well, I think that I had this mid-career stock recommendation. I was analyzing a large telecom company that I was recommending, and I pretty much made every single mistake you can think of. And by the way, this is not like, okay, well, it was my second year. It wasn't my second year. It was like 7 or 8 years into it. So I should have known better. It was, the company just did a large acquisition. Check. By check, I mean, that's a yellow flag at least, right? The company was a number 3 competitor in the industry and wasn't particularly, attractive in terms of past historical returns. Check. That's a negative base rate thing, right? It was a very capital intensive business. Check. It was a management team that was a bit self-promotional, and I met with them and they told me, oh, yeah, big acquisition. Yeah, for mere mortals, it would be difficult to integrate, but we're awesome and we're going to do it. Don't you worry. And of course, I felt a little bit more comfortable after hearing that. Check, And I did not look for disconfirming evidence. Then, on top of that, rather than thinking about these things at a high level qualitatively first, I proceeded to create a giant DCF model where I convinced myself that based on this intricate DCF analysis, the stock is really undervalued. And then just to top it off, I made sure to actually make an embarrassing Excel error. Like almost never happens, but it happened to me that time. I actually linked to the wrong cell, and that gave me an extra 20% boost in value.
Oh,
So, again, these are not things that like I probably shouldn't be discussing in a call, but you know what? It happened. B, I think that, if you handle these situations appropriately, you should come out stronger on the other side. Now, by the way, the first question that was part of a team at that point is like, so you found this Excel error. What do you do? Your mind tells you, well, I can fix the error, but I can probably find 20% extra value if I tweak these other variables, right? There's this voice in the back of your head that you don't want to go and tell, all your colleagues that you just linked to the wrong cell, but you have to do that. Like, you have to do that for yourself. You also have to do it to set an example to more junior colleagues about intellectual honesty and how you want them to behave, because you don't want people hiding things like that from you, right? You also don't want to start tweaking other assumptions to make up for the mistake. So, I did the right thing, but it wasn't pleasant. But I think the bigger conclusion wasn't don't make Excel errors. Of course, that doesn't need a lesson. It was, I kind of got into the weeds. I started believing my own conclusions way too much about the minutia of numbers and forecasts, rather than just doing a basic checklist of, is this a decent business? Are there things going on that are likely to have a very negative base rate implication on value? Should I even be like going deeper into this business? So I probably today, if I get a business like that, I would just say thanks, but no thanks. Right. There's just too many things that don't fit. And at year 18 in my career, or almost 19, I've learned the lesson that you don't have to dance with all the girls. You can just say politely, hey, you're a wonderful company. I'm sure other people will love you, but I'm going to move on. Right. And I think that was the lesson for me, but it was not a fun way to learn. It was, I think, we bought the stock at 15, and it's been, the last I looked, it was below 5. Yeah. So.
Yeah. Well, what's interesting is that, there's, while you have your, we earlier talked about, how behavioral value investors, more of like the value investing, married with human fallibility. What's interesting is that it's almost that, that simple value investing process that you've done 1,000 times maybe at that point, and that's where the human error was. It almost forced you to really delve deeper into, well, let's say just in case this does happen, what can I do as my check against perhaps faulty math, right?
Yeah, and by the way, it's simple sanity checks. Like right now, yeah. So I still use a DCF. I know some people hate it because it's garbage in, garbage out, but my counter argument to that is, well, you can hit your finger if you use a hammer to hammer in a nail, but that doesn't mean the screwdriver is the best tool for hammering a nail. It means you should learn how to use the hammer, or get someone else to do it for you if you can't, which would be my case in the case of a hammer. Mm-hmm. But I use a lot more kind of cross checks, such as what are private market transactions like? What does this valuation imply in terms of, kind of some price to normalized earnings, or EV to EBITDA kind of multiple, to make sure that there's no red flags. And by the way, had I done that for this company I just talked about as an example of a mistake, it would have been like, why is this not so hot business valued at 20 something times earnings? That's not growing very much. Like, what's going on? That would have clued me into there's some mistake somewhere. Either my assumptions are too aggressive, or there's an actual Excel error. So it's interesting because I've mentored a number of aspiring value investors, and occasionally I get someone like that who builds these intricate 300-line models, and I kind of empathize with them because I've been there, and they think value investing is about being really good at valuing things. It's actually not. Valuation is really straightforward. It's being a really good business analyst, knowing your comfort zone, knowing your biases, and waiting for the easy, pitches, not about being able to outsmart someone on line 293 of a model.
Mm-hmm. Nope, I completely agree with that. So my next question then is, what advice do you have for new investors?
Yeah, so I think it depends on how someone's approaching it. I mean, if you take new investor as someone, they decided they're going to be a stock analyst or a stock investor directly into stocks, I'll answer that in a second. But I think before you even get to that point, from people who are doing it for themselves, right? It's not like they got a job as a, equity analyst, but they're just, investors themselves. I would say, like, be honest with yourself is, do you have the time, the temperament, and the process to do this right? And I think it's not just the time. It's, can you actually, I've seen investors who have good process, but they fall apart. I have a friend who will remain nameless, but he is super smart, knows companies really well, but when things go against him, I get these texts like, "Oh my God, what do I do now? Stock is down, and like I don't know what to do." I'm like, "What do you mean you don't know? You did analysis, you have your value range, do that. Whatever your process tells you to do." But it's very hard for him to do that, right?
Right.
It's just he's wired a certain way. So I think knowing yourself, that about yourself, might suggest that, hey, maybe Vanguard 500 or some other broad index fund might be something to consider if that's you. But let's say you decided to pursue this and you love it, and you're good at it and you think you have the temperament. I wrote an article recently about the best investing books that can make you a good investor, and I use it to teach my value investing seminar. And I think, unfortunately, it's a long path. It's not like, well, you read The Intelligent Investor on the beach, it's a short book, and you come out on the other side, you're an awesome investor. Doesn't work that way. So I usually start my students with security analysis. We go through it part by part, and the bigger picture is you're trying to do three things. You're trying to understand what the investor you're studying did, then you're trying to apply, and then you're trying to customize to your own strengths and weaknesses. And the way I have mentored people is, let's combine thinking from first principles with studying from the masters. And let's use what we learn from the masters, whether it's Ben Graham or Phil Fisher or Warren Buffett or Peter Lynch or whoever. Let's combine that, figure out what their style is and why it works for them, and let's start thinking about how do we build a style for you that's going to play to your strengths and weaknesses. So if I am analytical, I don't, I meet sometimes great investors who are very qualitative, and I respect that and I admire that from afar, but I know it can never be me. I'm an MIT guy, I'm an ex-engineer, I need process and structure to my investment process. But someone else might look at it and say, this is a bunch of, over precise stuff, I'm just going to do it very big picture. Mm-hmm. So figure that out, but then use as heuristics, use as a guide what's worked for other investment grades, because you don't want to do complete trial and error. One of the challenges in learning to be a good investor is that the feedback loop is so long, mm-hmm. right? So when you learn to hammer in nails, you swing, and if you miss, your finger tells you did it wrong, and you see that the nail didn't go in. But in investing, you swing, and you have to wait sometimes a number of years to get the feedback or whether you're right or not. And I think you're trying to use the studying of these investment processes by investment masters to shorten that learning cycle, if that makes sense.
Yep. So then, Gary, as we round out the interview here, where can my audience go and find more information about you and everything they want to know about Behavioral Value Investor as well as Silver Ring Value Partners?
Sure. So I would tell people to check out behavioralvalueinvestor.com. It also links to my company site, Silver Ring Value Partners. But I would say the Behavioral Value Investor has much more rich content to actually help you guys make better decisions. Also, I recently launched a YouTube channel, so it's under my name. So if you just search for Gary Mishuris, where I'm going to regularly post videos on these very topics, so value investing and behavioral finance, and using them to make better investing decisions. So check that out. And you can always send me an email. It's just Gary@silverringvaluepartners.com. Always happy to hear from you.
Well, Gary, thank you so much for joining me today. This was really such an insightful interview, and look forward to meeting you in person soon.
Absolutely. Thank you very much. Really appreciate you having me.
Thank you, Gary. Thank you all for tuning in to the Planet MicroCap podcast, and thank you, Gary, again for coming on to the program. You can access the podcast by going on to stocknewsnow.com under podcast, go to podbean.com, iTunes, Stitcher, or Spotify and search Planet MicroCap Podcast. Stay tuned for the next Planet MicroCap Podcast, where we'll have our next guest to discuss all things microcap. If you have any questions or comments about the podcast, please send an email to info@snnwire.com. I'd love to hear from all of you. This podcast has been brought to you by SNN Incorporated, publishers of StockNewsNow.com, the official microcap news source, and the MicroCap Review magazine. I'm your host, Robert Kraft, and thank you again for joining me on the Planet MicroCap Podcast. Have a great week, everyone.